Hey, so if you're working for yourself in Canada, maybe you're a freelancer, a consultant, or you run a small shop, you know that tax time can be, well, pretty stressful. But what if you're accidentally leaving a ton of money on the table every single year? In this explainer, we're going to walk through the world of self-employed taxes and show you how to keep more of your hard-earned cash.
All right, let's just get right into it. When you're self-employed, tax season can feel like this huge, complicated puzzle, but it really doesn't have to be. We're going to break down the rules and show you exactly where you can find savings, turning what feels like a chore into a real financial opportunity.
So before we dive into all the cool deductions and important deadlines, we have to start with the absolute basics. And the very first question is this: in the eyes of the government, are you and your business the exact same thing? Believe it or not, the answer to that question changes everything about how you get taxed. For most self-employed folks starting out, you're what's called a sole proprietor. It just means that you and your business are legally inseparable. Your business income is your personal income. Simple as that. But, and this is a big but, it also means you are personally on the hook for any of your business's debts. Understanding this is absolutely crucial before we move on. Okay, now that you've got the whole sole proprietor thing down, let's talk about the practical stuff. There are a few key dates and one really important form you have to know about to stay on the right side of the CRA. Let's take a look. Go ahead and put these dates in your calendar right now. As a sole proprietor, your business tax year ends on December 31st. Super simple. Now, you have until April 30th to pay any taxes you owe, which is important for avoiding interest. But here's a nice little perk. You actually get some extra time to file the return itself. You have until June 15th to get all that paperwork in, so don't miss that deadline. The T2125 form is basically your new best friend come tax time. Think of it like your business's annual report card for the government. This is where you list all your income and, more importantly, all of your juicy expenses. Getting this form right is the absolute key to lowering your tax bill. And now for the really fun part, deductions. As a self-employed person, you can deduct a huge range of business expenses. We're talking everything from your home office to vehicle costs, software, and advertising. Every single dollar you claim here reduces your taxable income. Let's look at some of the biggest ones. The Canada Revenue Agency keeps it pretty simple with their main rule. Basically, if you spent money with a reasonable expectation that it would help you earn business income, you can probably write it off. But what does reasonable actually mean in the real world? Let's break down a few specific examples. Okay, did you know you can actually pay family members to work in your business? That's right. As long as the wage is reasonable for the work they're actually doing, like managing your social media or helping with bookkeeping, you can deduct it as a business expense. This is a fantastic way to lower your tax bill and keep more money in the family. If you work from home, you can deduct a piece of your household expenses, things like mortgage interest, utilities, and insurance. The trick is to figure out what percentage of your home is used for business. Usually, you just divide the square footage of your office by the total square footage of your house. Now here's the catch. These deductions can bring your business income down to zero, but you can't use them to create a business loss on paper. And what about your car? If you use it for business, you can deduct a portion of your vehicle expenses. To do this, you absolutely 100% must keep a detailed logbook of your business versus your personal mileage. Once you have that business use percentage, you can apply it to all these costs from gas and insurance right down to car washes. And don't forget all the other costs of just doing business. You can deduct advertising, fees for professional memberships, software subscriptions, office supplies, you name it. You can even deduct a part of your phone bill if you use it for work. So you really want to track all your expenses because they can add up to some serious tax savings. Now, when it comes to taking clients out for lunch or entertaining them, listen up. You can only deduct 50% of the cost. This is a hard and fast rule that catches a lot of people off guard, so make sure you keep good records of those expenses and only claim half of the total. So you're starting to get the hang of this whole sole proprietor thing. But what happens when your business starts to grow and get more profitable? Well, you might want to think about incorporating. This can open up some really powerful benefits, like protecting your personal assets and getting much lower tax rates. Let's compare. A corporation is a totally separate legal entity from you, the owner, and this is a complete game changer. First, it means your personal assets, your house, your savings, are protected from business debts. And second, it means your business profits get taxed at a much lower corporate rate instead of your higher personal income tax rate. So when does it make sense to incorporate? It's a really smart move for businesses that are consistently profitable. This is especially true if you're in a high-income field, like real estate or you're a successful consultant. By incorporating, you can tap into those lower tax rates and keep way more of your money working for you. The biggest draw for incorporating is that lower tax rate. As a sole proprietor, you're taxed at your personal rate, which can easily climb over 50% in some provinces. But a small business corporation, it gets taxed at a much lower combined rate, right around 15%. That is a massive difference. And that sweet 15% tax rate? It applies to the first $500,000 of your business's profit every year. This gives your business a kind of superpower for growth, tax deferral. You can leave more money inside the company, taxed at that super low rate, and then use it to reinvest and expand. It's a huge advantage for any business that's trying to scale up. So we'll leave you with this question. Smart tax planning isn't just about saving a bit of money this year. It's about setting your business up for a long-term success. By picking the right structure and using all the deductions you're entitled to, you can build a rock-solid financial foundation and create a really valuable asset for your future.